Selling of non-current assets. After companies use current assets for some time, they might decide to sell them. Assume that a company owns a truck which had a cost of $100,000, useful life of 5 years, salvage value of $10,000, and that the straight line depreciation method is used. After the truck is used for 3 years, the company decided to sell it. We need first to calculate the accumulated depreciation of the truck to get its book value on that date. The accumulated depreciation is the sum of the annual depreciation for the 3 years in this case. To calculate the annual depreciation, the salvage value is subtracted from the cost of the asset, then divided by the number of years of useful life. So it is equals to 100,000 minus 10,000 divided by 5 years, so the annual depreciation is equals to $18,000. The accumulated depreciation for the 3 years would be equal to the annual depreciation multiplied by 3, so it is equals to $54,000. Looking at the accounts of both the truck and its accumulated depreciation, the book value of the truck can be calculated by subtracting the accumulated depreciation from the cost of the asset, so the book value is equals to $46,000. A buyer offered to pay $60,000 to purchase the truck. The company accepts and received $60,000 and delivered the truck to the buyer. The truck does not exist in the company anymore, and hence its accounts, which are both the truck account and its accumulated depreciation, should be closed. Now we need to understand whether the company made a gain or a loss from such transaction. The company received $60,000 while the net book value of the truck is $46,000. Accordingly, the amount received is greater than the book value, which means that the company gained $14,000. To close the accounts, the following journal entry is recorded. Cash is debited for $60,000 as it is received. Debit accumulated depreciation to close it. On the other hand side, the truck is credited to close its account by $100,000. The difference between the total debits and credits is $14,000, which represents the gain on sale of assets, and it appears on the credit side as it increases owner's equity. Let us now assume that the buyer offered to pay only $35,000 to purchase the truck. The company accepts and receives the $35,000 and delivers the truck to the buyer. The truck does not exist in the company anymore, and hence its accounts, which are both the truck account and its accumulated depreciation, should be closed. To understand whether the company made a gain or loss from such transaction, let's see what happened. The company received $35,000, while the net book value of the truck is $46,000. Accordingly, the amount received is less than the book value, which means that the company had a loss of $11,000. To close the account, the following journal entry is recorded. Cash is debited for $35,000 and the accumulated depreciation is also debited to close it. On the other hand, the truck is credited to close its account by $100,000. The difference between the total debits and credits is $11,000, which represents a loss on sale of asset, which is debit as loss decreases owner's equity. Why did we use gain instead of revenues, and why did we use loss instead of expenses? If we look at the company's income statement and assuming that we are not differentiating between revenues and gains on sale of assets, we got a total revenue of $20,000 and expenses of $11,000, so the net income is equal to $9,000. In this case, the reader of the financial statement doesn't know that the revenues included $14,000 of gain on sales of the truck. Alternatively, if we differentiated between revenues and gains, revenues will be presented as $6,000 only, and the company will be having an operating loss of $5,000. Then the gain on sale of the truck, $14,000, is added to make net income equals to $9,000. It is the same result, but now the reader understands that the net income is not resulting from the main operations of the company, rather it is because the company sold the truck and gained from such a transaction.